Hello, friends. Welcome. Wish you a very, very happy new year to you today. It's a happy new year in terms of the financial market. So, financial calendar says happy new year, and definitely it's not going to be a fool's day today because we are going to have a very interesting topic on Ichimoku and Harmonic's pattern. So, for this, in today's FNOK Charcha, we have with us Mr. Dinesh Nagpal, who has over 2 decades of experience in trading and investing. He is a full-time investor and trader. And today, what we requested him that he can share his ideas and remove the cloud of Ichimoku and Harmonics to us. Hi Dinesh, welcome to our show on FNOK Charcha today.
Hi. Hi. Yeah, hi. Thank you for having me over. It's an honor to be here.
Welcome Dinesh. Along with us, we have our speakers, Peter, Manas, and myself. Today we will be hosting the show with Dinesh. We'll be asking questions to Dinesh. In case you have any queries or doubts, please feel free to ask questions and you can directly DM us. That's one. And I would request you, if you're listening to us, you can share our this notification in your tweet so that many of your friends can also get benefited. So welcome to our show, Dinesh. And welcome everyone. So Dinesh, how did you start your trading journey?
Yeah. So my trading journey goes back to 1989, just after I had was finishing my college. And I joined my family business, which was the import of steel we used to import. So at that time, there was this surge of IPOs which were coming in the market. So till then, the market was, saturated to big stocks like Bajaj Auto, and at that time, Century Textiles or a Colgate or a Hindustan Lever known at that time. So I was introduced to couple of my friends and my business colleagues to that these IPOs are coming, the new stocks are getting listed in the exchange, so get into it. So what started initially was IPOs, and from there came the when you move in a group of friends or you meet people and you start talking about the stocks and all that. So at that time we had this market used to be only between 12 to 2, and there were regional stock exchanges. Calcutta, I'm being from Kolkata. That time it was Calcutta Stock Exchange, CSC. So we used to have trading between 12 to 2 in the ring. Of course, you had to go through a broker, and the broker would communicate in the hall to the jobber out there. So it had become a system where business between 12 to 2 was in the stock market. So initially it was more about from IPO, it became investing, buying stocks and then selling them at an appreciation or sometimes you're stuck. Then it became trading full from 12 to 2 and then back to my own business. And then saw the Harshad Mehta, the scam which took place, got a bit burnt in that also, learned a lot of things. And then came the era of NSC digitalization and the DMAT systems and all that. Saw the 2000 .com bubble also in that time. But all this time, I was primarily into my family business. Trading was more about reading about a stock in a magazine, say like Capital. That time, Capital Tele used to come, or Dalal Street, or Economic Times Business Standard, or word of mouth, listening to people, this stock is good, that stock is good. More of investment, not speculation and trade, but trading, buying and selling, like that. Then saw the .com bubble. Then from 2003-4, when the market revived after that small 3-year gap, the market by that time had seen a nascent stage of development. From a manual market, we were now totally digital. Plus, we were now introduced to technical charts, which were missing in the earlier part, in the 90s and all. There were very few people knew about technicals on it, but now the Western world influence had already come in. We could see charts. There was Advanced Get, there was Meta Stock, there was ME Broker, and you had data service providers who were giving you charts of nifty stocks and all the top stocks, and you could start reading. So in 2005 I got introduced. That time we had this Yahoo Finance and Orkut before the what do you call WhatsApp days and Twitter days. So there I was
Yes, I remember.
introduced to, yeah, so I was introduced to from a kind of in one of the forums, that why don't you start looking at charts and read, instead of going by word of mouth from people here there, and listening to what to buy, what to sell. Trading cannot be done like that. Investing, yes, you can read the data, you can follow it, right, but trading you need more accuracy, because it's at times it's already discounted, at times the news could be wrong, or you could get trapped. So got introduced to the world of technicals in 2005, 6, like that. And at that time, because I already always had a part in trading in the market, always fascinated by this market. So I took a very big decision in my life that I would move out of a family business totally, and I would become a full time trader come investor. This was back in 2006 a decision, and I became, over a period of a year or two, I became fully into trading totally. Saw the 2008 subprime, was very fortunate to read it out early that this is looking very bad to me, that one, and moved on with that. Saw the 2011 to 2013 a complete sideways dull market. Saw all that. Saw the resurgence from 2014. Saw the COVID one, but my introduction to harmonics and Ichimoku came in 2014, again through a group where this Western world, Ichimoku is a Japanese study, while harmonics is a study which is derived out of some of the best studies in the world, which have been running for over 100 years. Primarily, the source is Ralph Elliott and W.D. Gamble, but Ichimoku and all of the Japanese study, very few people in India would talk about it in social media. Very few people, or most people, had not even heard of it. So in 2014, I got hooked onto it, read a lot of books on it, met a lot of Ichimoku traders overseas and in India, and got into it. And from 2019, I have been training, teaching, and becoming a mentor on harmonics, Ichimoku, and trading psychology risk management. So I am a trader full time. That's my bread and butter, earning my living. I'm an investor and also a trainer. So all three work together for me like that. It's been a big journey, but it's not been extremely rosy also. Okay, so as a trader, you have major ups and downs. So each down, initial part that was in 2006, and a few here and there, each loss teaches you a new thing. Each correction teaches you. It's important to remember, as a if you want to make it big in the world of trading, that do not mistakes will always happen. They will happen tomorrow, they will happen day after, but it is important to realize that you don't do that mistake again. It's like, I'll give a simple example, if you don't mind, in Hindi. आप रास्ता में चल रहे हो और आप एक केला के छिलके के ऊपर गिर गए और आपको चोट लगी है। कल आप वापस उसी रोड में जा रहे हो और वो केला का छिलका वहां है, तो आप क्या सोचोगे? अरे आज वापस गिरूंगा क्या उसके ऊपर, या आप साइड से निकल जाओगे? Right. The first time is a accident which is not in your hand, which you didn't realize. The second time is a blunder, like that. So each time when you come across a crisis, the best thing to do is get out of it instantly, as fast as possible. Recognize your mistake, recognize the flaw, get out of it. Do not try to hold on to it, and try to make a mechanism which you don't repeat again. That one. So that's been my journey from 89 till 2022, from a part-time trader investor to a full-time trader investor and a trainer mentor coach in different studies. Yeah.
That
Wow.
was amazing. That was
Amazing.
amazing. I still remember in those days, back in the 80s and early 90s, when I used to visit my father's office in Dalhousie, the Calcutta Stock Exchange, and the crowd which used to be out there,
Yeah.
amazing. You took me that time.
Crazy.
Very nice, amazing.
Yeah.
Very amazing journey, sir. Amazing journey. I think when you started in 1989, हम लोग कई लोग पैदा भी नहीं हुए थे लगता है आपने ट्रेडिंग स्टार्ट किए थे and
Well, it
and अपने
started as a
2005 में
fascination.
yeah in 2005
Right.
when you started your technical analysis in 2005 when you started in technical analysis हम लोग को वो टाइम पे टेक्निकल एनालिसिस का टी भी नहीं पता था
हमें कोई
सर वो
सॉफ्टवेयर
आज
नहीं
भी
होते
लोगों
थे
को नहीं पता
ज्यादा।
है नहीं, unfortunately, even till date, none of the academics, universities, they speak about it. You see any class 11, 12 syllabus or college syllabus and all that. Nobody talks about technical analysis is a field. Very few institutions talk about it, like BSc talks about it in their master's program, or the private people talk about it. In India, nobody talks about it. So, even if when you give the SEBI exam for an analyst or a advisor or anybody, out of 700 pages of the syllabus that you study to give an exam, out of 700 pages, not even 7 lines is on technicals. So it's a complete it's ignored in India by the institutions or the university, the academics. But you can look at it from the positive aspect that we have miles to go. We have not even explored that market till now. We are very early. Very small percentage of the public is into it right now. Yeah.
राइट सर आप अभी हम लोग टेक्निकल के बारे में बात कर रहे हैं एंड ये सो द थिंग इज लाइक अपना 11th 12th और कॉलेज में अपने के लिए पर्सनल फाइनेंस के बारे में भी नहीं सिखाया था राइट पर्सनल फाइनेंस के बारे में ही नहीं था हम लोग टेक्निकल के बारे में सोच रहे हैं मैं सीखा था टेक्निकल या आई इंट्रोड्यूस टू टेक्निकल व्हेन आई वाज इन एमबीए राइट so anyway coming back to our topic so when we talk about the technicals अब लोग इमीडिएटली माइंड पे आता है कि कैंडलस्टिक चार्ट्स और बार चार्ट्स यही हम लोगों ने देखा था सो दिस समथिंग न्यू फॉर अस आल्सो आई हर्ड बिफोर दिस आल्सो आई स्टडी समथिंग बट इट्स न्यू फॉर मेनी पीपल इंक्लूडिंग मी लाइक हार्मोनिक पैटर्न्स एंड हिचिमिको कैन यू प्लीज एक्सप्लेन व्हाट इज दिस इसमें कैसे ट्रेड करना है ये क्या होता है
ओके
हाउ इट इज डिफरेंट फ्रॉम कैंडलस्टिक
No, we use candlesticks. You can use bar charts. You can use candlesticks. Either of the two doesn't matter. Either of the two will work in both the studies. Now, I'll start with harmonic patterns. Now, harmonic patterns is a study which is derived out of two things. Number one is the structure, and the number two is the Fibonacci ratios. Now, Fibonacci is not the name of a person who developed the study in the 13th century and 14th century. It's done by a gentleman by the name of Leonardo del Pasa. But the ancient literature which we have in India suggests that Fibonacci was actually discovered in India in 600 AD by mathematician scholar by the name of Virahanka, and later on again in 1800 by Gopala and Harishchandra in 1100, much before Leonardo del Pasa. But because we didn't have that kind of literature, writing works, so someone else takes the credit out of it. But anyway, coming back to Fibonacci. Now, Fibonacci is something which is found in nature. It's found if you take a leaf, the lines in the veins in a leaf have Fibonacci ratios. Our planetary system works in a Fibonacci ratio system. The distance from one planet, the rotation and all that. The pyramids are made on Fibonacci ratio also. The petals of certain flowers have Fibonacci ratios arrangement in them, which is a natural process. Now, what is trading and investing? Trading and investing is nothing but emotion. The volume that you see in a stock, the buying surge or the selling panic is nothing but emotion being converted into price action, right? Because tomorrow, if there is a news that the price of X a commodity is going to go up, so what happens in the market? Everyone the next day goes on chasing those commodity producers, or vice versa. When there is a noise of, like few days back, there was thing that the US would give excessive supply of crude. What happened? So the companies related to that felt the brunt of the selling pressure on that. So, Simi, what is that? Basically, we are converting emotion onto the screen, which we read in the form of charts. Now, in no market, normally, I'm not talking about small cap stocks, most markets do not work on a vertical basis. If the price of a stock or an index goes up, it comes down, goes up, comes down, right now. So that is a study of against emotion. Structures are being formed from a low to a lower low or a high to a higher high, etc., like that. So in harmonics, which is in the world market, you can say it's been practiced from in the Western world. It started in the 90s, but now it's extensively used all over the world because all the charting softwares that are there, that is, whichever one you use today has harmonic indicators. Or even if you don't have, if you have a software which does not have harmonic indicators, you can use the Fibonacci tools to measure. Now, coming back, so the harmonic study may be being practiced for the last 30 years, but its source of origin is very old. The shape of the structure, what we call, is derived from Ralph Elliott's Elliott waves and H.M. Gartley, on whom one harmonic pattern has been named the Gartley pattern. While the ratios are taken by W.D. Gann, one of the biggest geniuses along with Ralph Elliott when it comes to markets. So what Gann studies have done or Elliott studies have done are mind-boggling. And over 100 years ago, imagine when there were no computers. And the other person who has played a huge part in it is Bryce Gilmore, who is the father of market geometry. So what geometry we learnt in school is now being practically used in charts. Simple geometry. So combination of these four comes out harmonic patterns. But the best part of it is that you do not need knowledge of all those four studies separately. The entire study has been made so simple, so basic, based on its patterns, and each pattern has specific ratios. Now, why harmonic patterns? Why not any other study? The reason is that harmonic patterns are contra signals. That if a trend is ending or a trend is if on the uptrend is ending or the downtrend is ending in the time frame you are trading. So it works in all time frames. So from an intraday perspective or a positional trader or an investor perspective, so it gives you a signal that now the stock is exhausted, it will turn. The pattern, the shape with the ratios is matching for a reversal. So I'll give you a recent example. On over the weekend, PVR and Inox announced a merger. For every 3 shares of PVR, you are going to get 10 shares of Inox, which is a very good deal for both of them. And on Monday morning, the stock PVR opened 10% up, around 1950. At exactly 1950, there was a bearish harmonic pattern set up in the daily time frame. So, no, very, very few studies in the world will give you a signal, technical studies of a reversal, because most studies are based on data, that is past data, and data is always a lagging indicator like an oscillator. They convert, but harmonics works on pattern and price action. So it caught the reversal out there for a exit. Now I look at harmonic patterns not just for a contra trade. Okay, I look at it first and primarily as something which tells me that don't get into this now, save your money. While the whole world is chasing it, now you don't need to chase it because the pattern has been set up for a sell out here. You can wait for the sell pattern to get invalid, or on the first opportunity of weakness, you can short it or you can just skip it, because it's not necessary to trade every time. You can just let the trade go away from your hand. Similarly, another example was Dalmia Bharat. In the hourly, there was a heavy selling last week. On the hourly, it gave a bullish harmonic pattern. Again, very few studies must have suggested a buy. It suggested a buy signal out there. So like this, I use harmonic patterns because they stand out in contra trading, contra reversal, and with a if you follow the structure, if you are a disciplined trader investor, you match the ratios, they will work in your favor. The what you call the hit ratio is much high. Now, of course, they also fail. If everything would be 100% correct, then we would never have accidents. Everything would be perfect. So even if you have the best brakes in your car, and if you have a ABS in your car and a airbag, doesn't mean you can go and bang your car and nothing will happen to you. You could still get hurt. Right, the probability is there. So we follow certain rules and structures and harmonic patterns. When the ratios will meet, when the structure sets up, we look for a trade. First, we look not to get trapped into that part of the trend which is ending, which is exhausting, and then we look for the reversal while everyone is napping in that trade. That's harmonic. Now the next one, which is Ichimoku. Now Ichimoku, a little bit of history about Ichimoku. It is a study developed from 1930 to 1960 by a Japanese journalist by the name of Goichi Hosada. Now, Goichi Hosada took 30 years to develop this study. Its elements are out of moving averages. A lot of people use moving averages for their trade, but the way he set it up, he took different kinds of moving averages, specific, and he tweaked the whole structure up. So, Harmonic Ichimoku on its own is such a beautiful system that you do not need any other study to tell you, is this trend correct, is the trend. So it not only does it identify a trend, whether uptrend, downtrend, sideways, it also tells you the acceleration of the trend, that now the trend will accelerate, now the trend will be a drag. And the biggest USP of Ichimoku is that apart from GAN, no, no study in the world tells you time. The Ichimoku study is made on the concept that time is primary. The movement of price from point A to B is just a consequence of that. So if a trend is supposed to say last for say 60 days, as per the study, so price could move from A to say which is at 100, could move to B, which could be at 150, or could move to 200. That's if that will come secondary. But if the 60 days are over and the cycle is over, then the trend is complete out there. So that's the beauty about this study, Ichimoku, which I like to use because not only does it give me 100% package of trend, acceleration, and timing at the same time. So I use, and Goichi Hosada took 30 years to develop this study from 1930 to 1960. It got journalized, it got written and all. And by 1980, the Western world was using it extensively. And I'm proud to say that from 2019, I've been teaching this in through my students, and I have made my own Ichimoku army of students. I've taught thousands of students the study. I've made them get into it, and it's a beautiful study on its own. It's called Ichimoku, not Goichi Hosada. There's a reason behind that, because Ichimoku in Japanese means what a man in a mountain sees. So you are at a clarity, and with one glance of the chart, you can decide whether it is an uptrend, downtrend, or let's forget it for now. Like that. Yeah.
Wonderfully explained, Dinesh. So, in harmonic means you talked about multiple ratios. So, can you explain like what all are these ratios? Are those
Right.
like Fibonacci series ratios, and which ratios we should take? And like for a new trader who
Yeah.
is like new to harmonic patterns and Ichimoku, so can you give an example with a stock and like what all ratios to take to enter into to use harmonic patterns for
Yeah.
his for our trading?
Yeah. So just like I told you about the PVR case, PVR on this Monday had touched 1900 something and had formed a butterfly pattern. There are many. There are over 30 patterns, but the most extensively used patterns are around 15, which I practice. Around 15 patterns. Now the butterfly pattern, it's made of 5 legs, and we label each leg from a starting point to a low point, and then when a stock goes up, down, zigzag, we label each one. So we call it X, A, B, C, D. Now, in this butterfly pattern, the XB ratio, that is from the Fibonacci ratio from point X to point B, has to be near 78% Fibonacci. And the XD ratio, that is the terminal point where the stock will turn, should be near 127. So 78 Fibonacci matches 127. So not only is the study looking at a structure, but also the ratio should match. So it's just like when we were in school, we were doing geometry. If you were doing a Pythagoras theorem, or simple thing, when you take a paper and you make a paper rocket in school, so you bend the sheet properly, you get the crease out proper, so then the structure balances, right? It can't be leaned on one side. So similarly, it's just simple. We are just getting into the basic formation of a structure. Or you could say, no, it's just like you buy a shirt or a jacket. So what do? The first thing, when you wear a jacket, you check the length of the sleeves or the shoulder, whether the shoulder is drooping or not, right? Whether the comfort is correct or not. So what is that? That is the entire balance of the jacket suited to your body. So similarly, in harmonics, not only does the structure set out to the eye, but also the ratios match. So that's a butterfly pattern. Apart from butterfly, we have Gartley, which will have a different ratio. We'll have cipher, we have shark, we have alt shark, we have bat, we have alt bat, and like this. There are many patterns which come into place in harmonics, and we look at the each time a same stock can have different patterns forming out. So we look at the whole setup, we set it up, and then we trade according to the pattern, like that. So the primary one, like I told you, Gartley is one of the people because of whom the harmonic pattern study started. So one pattern is dedicated to him. It's called the Gartley pattern, and it's very commonly the success ratio of a Gartley is very high once found.
Hello, Dinesh.
Yeah, Peter. Yeah, tell me.
Yes, yes. Great, great. So like you spoke about, it can be used in understanding whether the stock will turn bullish or bearish. So that's coming to
Yeah,
directional trading. But can it be also used
yeah.
to find out non-directional trades? So especially for option writers
No,
who would like to go.
harmonics you cannot do that. In harmonics, you cannot do that because what is harmonics? Harmonic is about a contra reversal happening. Okay, so we are looking at a minor top or a major top or a minor bottom or a major bottom. So it is in fact a level where the reversal is happening and you are buying the opposite side option. So in the case of like PVR, I would buy a put, or like in the case of Dalmia Bharat, which I told you, I would buy the call if it is available, if the liquidity is there, or I'll go with a cash or a future long at that stage in it. That for the purpose of what you said, non-directional, I use my Ichimoku study. Like I said, Ichimoku is a full package where I come to know whether the direction is uptrend, downtrend, or this is going to be a completely sideways, narrow ranging market where it will, or even in a case of a stock. So I can identify that, and accordingly, I can short a strangle or a short a straddle, or set up my trade accordingly, and eat the premium at that moment of time in that trade, which is very common in the case of the weekly index options.
Okay,
Right.
great, great. Dinesh, we have seen like
Yeah,
there are many traders are there, and everyone has their own studies, right? Some people may believe in option
yeah,
selling, some people believe in option buying, some people may like Ichimoku or harmonic patterns, some maybe candlestick patterns, some maybe fundamentals. So or derivative data. Means everyone has their own way of trading, but you have a
Yes.
lot of experience in this market. I want to understand what are the essential qualities to become a successful trader. How can be a successful trader?
Yes.
Like there are a lot of studies where maybe people may may
Hmm.
get confused or something. So what's your advice? How can we become a
Yeah.
successful trader?
Okay. So number one, ultimately all roads lead to Rome. If the technical study you're doing, be it Ichimoku or harmonics or moving averages or candlesticks or PNF or GAN or Elliott wave or whichever study, Bollinger Band, RSI, whichever study you do, try it. As my advice to anyone is, go to the full depth of the study. Don't do a half baked thing. I'll study half of this. अरे ये समझने नहीं आ रहा, ये बहुत कंफ्यूजन है, इसको यार कोई शॉर्टकट होना चाहिए नहीं. There is no free lunch in the highway. You have to ultimately slog it out. You must understand the study. The persons who have developed this study, maybe some may be more than, see, candlesticks are 400 years old, but or whichever study you do, that has been well documented with thousands of examples. So the person who made it or the people who made it have done a lot of research. Today a lot of algos work on that, a lot of automation comes into the place. So go into the depth of a study, go as much depth, keep learning. Do not, number two, to be essentially a good trader, see, according to me, a trader is just like a sports player, right? A sports player like a Dhoni or or a Sachin Tendulkar, they or a Virat Kohli, they don't lose the process. Okay, they follow a process. They also know this, that if they score a century today, they might get out for a duck in the next match. Okay, so each innings of a player is a new inning. So similarly, in trading, every trade is a new trade you get into. So to be a good trader, the most important thing is to control your emotions. If you cannot control your emotions, then you are not for this line of works, because that's exactly why most from a trading point of view, people tend to fail because they have no control of the emotions, especially when a trail stop loss is hit. The fear grips, in anything we do, right from our school days. Of course, today capital punishment is completely banned. When we went to school and we had a strict teacher in school who would raise her or his hand on us, or would rebuke you or tell you, I'm going to call your parents, or ridicule you in a class and all that. So what happens to those students in a classroom? Fear grips them, right? So they panic, they don't do well in that subject, or the studies deteriorate, they get distracted into the wrong thing. So similarly in trading, if a fear will grip you in a trade that you are doing, you will not be able to exit a loss making position. So you cannot let that happen. You must follow a process. Be whichever study you do, respect the study. Okay, a study does not go wrong. It is the interpretation of the study which goes wrong. The minute you realize it, or the hour you realize it, or the day you realize it, take it, get out of the trade. Because the probability of one trade making you a billionaire or a millionaire is not even 1%. But a one trade which is held wrong, and where your M2Ms are going to get eaten and your money is going to get wiped, is higher than 70%. Okay, so don't put all your eggs, your fruits, or whatever you want to call it, in one basket. Spread your risk, learn to be disciplined, respect the stop loss. Okay, now that's why I say, analysis is it can be outsourced. Your broker can tell you what to buy, sell. Your friends can tell you. Today WhatsApp groups, Telegram groups, Twitter, XYZ, everyone has a view to share in the market. You could copy paste a trade view, but the management of the trade is yours. So you must learn to first respect the trade. So whenever anyone tells me that buy this or sell this, or this is looking too good, the first question I ask that person is not what is the target for the stock. I ask, what is your stop loss? Tell me that. Because what we see on the screen as a chartist, or Forget from a chart point of view, from a layman who has no idea of stocks or trend. We don't know what will happen tomorrow, the next hour, or anything. If we knew that, we would be God, right? So we only are working on probability based on the study of the past. The future is uncertain. We are working on a probability. And the only way to be successful is to follow the process and continue to trail your winners. That's another important aspect. I see a lot of traders who buy, say, they'll buy Nifty at 17,500 and they'll book Nifty at 17,050, 550, 50 rupee. But that same trader will hold on to a loss making trade till 17,000 till the broker wipes out his trade. So what is the logic they use in that trade? अरे प्रॉफिट बन रहा है ना, जेके निकल जाओ, ये तो मार्केट वापस गिर जाएगा, ऊपर से मिल रहा है ना, मेरा काम हो गया, फटाफट लेके चला गया. No, even the best of the best intraday traders have a risk reward management rule. Remember, the market is like a casino. If you want to beat the casino, you must have a proper risk reward management. Else you will never be able to beat it. You're just gambling your money away in the system like that. So number one, follow the process. If you take a study, go into the depth of the study, respect the study. Number three, control your emotions. Control your emotions. If you cannot have a control on your emotions, if you get carried away, well, like I said, the example of fear gripping you when you get it wrong. The other is extreme greed, that you are just jumping. You're not. You're adding more and more, more and more without a proper risk management. You'll get blown. You won't know what hit you one day like that. So, if these are the three most essential aspects of trading to be a successful trader, you have to have discipline day in, day out, and be prepared that if you get a hit ratio, that is, your successful trades versus non successful trades are at 50%, then it is fantastic. Anyone who claims that he or she has a success ratio of 70% is नॉट लेस देन गॉड. प्लीज उसके घर में जाओ, उसके घर में ही रहो, उसको अपना सब बना दो. 70% इज प्रोवाइडेड वो एक्चुअल में होता है, इज माइंड बॉगलिंग. It is completely mind boggling if that person has a good risk reward ratio. It shouldn't be 70% ki buying at 17,000, selling at 17,050. The correct ones and the lost ones are being squared off at 16,800, 700. No, at least a 1:2 success risk reward is there and it's being respected. Then you are a mind boggling trader if you are doing that. Okay, that's the definition. Absolutely simple. Follow the process, respect it day in, day out, and you will get it wrong. When you get it wrong, get out of the trade. The minute you realize it, get out of the trade instantly. There is one more thing, that don't hold on to an alligator. Supposing you're in a swamp and an alligator grabs hold of your ankle or your knee, you're not going to fight that alligator, because first it will take your ankle, then your knee, then you, the full. So you let that alligator chop off that portion and you swim to safety. So holding on to a loss-making trade, derivative, purely derivative or margin funding trade, is like an alligator eating you slowly and slowly. So that's it.
Yeah. Dinesh, yeah, it's a wonderful answer for my question to be a successful trader.
Yeah.
I have one more question along with this.
Yeah.
Like, how we can come to know that what is the success rate of my strategy or my setup? So people may do some back testing,
Yeah.
and they may say, like, after doing a 2-3 years of back testing, it may be giving as a 70% or 80% probability of winning.
Yeah.
So what is your
Yeah.
take on this?
Yeah. Yeah. So when I do my mentoring and training to my students and all that, the first thing I tell them is back testing is good. It's not bad. It's a thing you can check for the probability of the study is correct or not. It's like paper trading, right? But remember one thing, paper trading is like playing Monopoly among friends. Okay. But actual trading is where the emotions come to play. Now, tell me one business in the world or any occupation or what do you call job in the world which shows you your M to M every second. So today, with all the apps and everything, every trade that you start, you can see your M2M profits constantly or your losses. But that the broker gives you from a point of view that your account could be in danger, or you're reaching a target, please book. That's making your job easier, especially from the risk. The broker, the idea of that is that. But what happens to us humans is that we get carried away by that. We get emotionally out of control by that. So now coming back to the back testing part, back testing does not test your emotion. Paper trading does not test your emotion. If your stock is moving in the correct direction, you're not squaring it off, right? Or if it is hitting a trail stop loss, you'll update stop loss hit, exit, or you'll make a journal entry of that in an Excel sheet or a Word file or any software. But when you do a trade on your own, then that emotion is tested of yours. So I tell all my students and everyone that don't have to do a large quantity. Okay, do a small quantity. Start with $1,000 only. Okay, do a trade, follow the process, and then scale your capital higher. It's like passing a school exam or a what you call a MBA exam or anything, going semester by semester. So upgrade yourself based on your performance. So for that, you need to journalize your trading journey. For every trade you do, you must mention what rate you started the trade. At that time, what was your stop loss for that trade? If the risk was very big, make a star mark on this, that this was a very stupid thing to do. Maybe you made money in it, maybe you did not make money in it. Because if the risk is high, there's no point trying to do it, right? It's not worth it. Leave it. The doctor didn't tell you to trade every day, so leave that trade apart. Then the next part is, what was your target? Then was it achieved, or was a stop loss hit? There it is very important to mention, did you follow the process when you initiated the trade and when you squared up the trade, or was it impulse out of fear that you exited early, or you got trapped in it? So once you make a journal of this process of yours, at the end of the week, end of the month, or end of a quarter, you come to know, this is a self assessment, where do you stand in trading? Where do you stand? Are you capable of trading, or you are not capable? Have you improved? Have you deteriorated? And also, as individuals, it makes us highlight, which I tell all of them, that individually you have to realize whether you are a risk seeking individual or a risk averse individual. If you are risk seeking, then if you follow the discipline, then you are made for trading, maybe derivative, margin funding, intraday, whatever. But if you are a risk averse person by nature, that will be reflecting on the way you trade. It's not for you. You are better off being an investor or a person who buys in cash, holds it, sells it when a price comes. So you're not leveraging out there. So individual, this is what is important. Journalizing your way through it. It's like a report card. You can bluff the whole world in social media by saying, like I always tell a lot of people that in the COVID crash in social media, I saw nobody trap. Everyone was making money shorting. Everyone had spotted the top. But how is that possible? How is that possible? Not practical. Someone had to be trapped somewhere. Then only it works. Now, for every buyer, there is a seller. So you can bluff the whole world, but you can't bluff yourself. End of the day. So this journal helps you in realizing where you stand. Yeah.
Yeah, wonderfully explained, Dinesh, about the multiple aspects like being emotional and for emotional aspect of trading and following the process. So I had one final question regarding the topic of Ichimoku and harmonic patterns. So like for our users, can you
Yeah.
help understand like what are the tools and how we can use these indicators practically? And in Ichimoku, especially since you
Yeah.
told it is made up of multiple moving averages, so how it is formed in a particular chart
Yeah.
and how the trader will use it?
Yeah.
What all ratios to use? What are the parameters
Yeah.
required for both these indicators?
Right. Yeah, so Ichimoku, today the Ichimoku software, the indicator, the study is there in every trading charting software. Everyone has it. So you just have to click it. It will come on the chart screen. Now, in Ichimoku, we call above the cloud, below the cloud. If a stock is trading above the cloud, it is bullish. If a stock is trading below the cloud, it is bearish. Okay, so uh, when I trade Ichimoku, my first thing is I don't just look at blindly one single time frame. I try to do a multi time frame setup in which I see what is the direction of the higher time frame. If the higher time frame is bullish, say intraday trader. Okay, so if the daily is giving me a bullish chart signal, then what I will do is then I will go to the 60-minute and I will set what if the daily, then what direction is the hourly going. If the hourly is going bearish, then I might short the market in a 15-minute time frame, but in lesser quantity. But if the hourly is also showing a bullish direction, showing that it is also going above the cloud like the daily is, then in the 15-minute I will go aggressive long. So I use multi-dimension, multi-time frame in Ichimoku, setting up all the things. So the simple minimum characteristics of Ichimoku is above the cloud, below the cloud. Of course, it has got many constituents, which I just can't explain in a small chat like this. We break up each constituent and we see how the equilibrium is set. Is the equilibrium bullish? Is the equilibrium bearish? Like that, which is again a one glance thing. It's not too much of rocket science or anything, just basic, keeping it as simple as possible, and then trailing the stock. Trailing is very important. Trailing a winner is very important because every day you don't get big catches, right? So you have to constantly. So we trail the winner using one of the constituents which we call the baseline in Ichimoku. There are 5 constituents. One of them is the baseline. We use the baseline that till the time the stock does not breach the baseline, we try to be with the winner in that trade as much as possible. Yeah. So that's how we use Ichimoku, using not just one time frame, multi time frame, setting it up together and going for the trade. Yeah. And for harmonics,
Right. That's
again,
amazing.
the software, yeah, yeah, the harmonics also, the softwares are there. All the charting softwares will, the modern one, all of them have harmonic indicators. But if someone has a charting software which is like an AMI broker or a Meta stock, advanced get, which don't have, no harm. Don't be disappointed. Use the Fibonacci retracement tool for that purpose. Same thing. The only thing is that you'll have lines, horizontal lines coming, and not automatic what do you call plotting of the harmonic pattern, which in the indicator is easier for you to plot.
Right. That's amazing. So
Yeah.
if the stock is trading above the cloud, so then it's bullish. So even if it's a
It's a
red
bullish.
cloud and it
Yeah.
trades above that cloud, then also it's
No.
bullish.
No, in Ichimoku, we have something called the leading indicator. Leading indicator. The
Okay.
leading indicator has to be bullish. The leading cloud has to be bullish. If the price is above the
I,
cloud, the leading cloud needs to be bullish. And if the price is below the cloud, the leading cloud, which is plotted ahead. So that's why it's called leading. So that has to be
okay.
what you call bearish for below the cloud. Then it matches. It's a study of 5 different constituents combined together, which give us a signal. In that.
Yes. Okay.
Yeah.
So that's amazing, Dinesh. That was very good.
Yeah.
And we
Yeah.
really enjoyed your session, the way you nicely explained us. So it was really very helpful
Thank
for
you. It
us
was a
today
pleasure.
to understand.
It
So
was a
I'm
pleasure.
actually
It's a
implementing
pleasure
it.
to be here. And
Yes. I was just actually putting it on a 15 minutes time frame and trying to see how it would have worked. Amazing. It's looking quite
yeah,
good, especially Ichimoku
yeah.
Cloud.
I
So,
keep post I keep posting my charts on Twitter and like this and LinkedIn also and all, where I post the Ichimoku criteria and all. Even the like when I see a time is over for a trend, I even give a
hmm,
warning in advance that there is a price and time equilibrium happening out here. That is that the movement of the price, whatever it could do, it has done because time is over for it. So now we could see a reversal happening out there, a major reversal. taking place. So caution, caution where I don't want, like, the basic idea is we share our ideas to, that's how social media works, right? We want to, it's not something like, the world has advanced so much that we are constantly, the news is non-stop 24/7 to us. So by news I don't mean news channels, I mean, ideas are being told
Information.
constantly. So the whole idea is to,
Yes.
so we are just trying to express something like that, what we have expertise in, we want to give it to the public like that. Yeah.
Right. So in the Dinesh, this is a very out of the box
Yeah.
question. We generally don't ask, but we are asking you because of your experience in
Yeah.
this. So where do you see Nifty in the coming years?
Hmm.
Coming years.
In the
Not in,
years,
I'm not
coming
talking
years.
about day, week,
Okay.
months. In the coming years.
Yeah.
Year or years?
Okay. Okay, so for this year, for first, let me talk about this year end. I would say this year end. For this year end, I would say I would be looking at Nifty at around 22, 23,000 at least 20 to 20. But there could be a correction before that. But ultimately 22, 23 for this year. And over the next couple of years, we are looking at around 40,000 Nifty, like that. The growth story is excellent in India. We will have small falls like this. And so remember one thing, whenever you, this is for the general audience, whenever someone tells you it's going to be a major crash coming, you can check the history of markets. A crash only happens once in 10 years. The cycle of a crash is 10 to 12 years. You can see 92 as a crash cycle, Harshad Mehta. You can see 2000.com as a crash. You can see 2008 as a crash. And then you can see 2020 as a crash. Okay. So crashes do not come otherwise. Crashes take a long time. It's an end of a cycle which takes place, and cycles don't run in small phases. You'll have up down corrections like this. From October we've been having a correction till March, but you have to look at the market, especially for the millennials who joined the market after COVID, right? So you must remember, from COVID low, that is 2020 March, till Diwali 2021. That's 18 months of no correction in the market. 18 months of a jolly good ride. So what have we seen
Yes.
from that? We've only seen 6 months of correction. And corrections are cycles. Corrections are opportunities to add good stocks to your system. So there are opportunities. Okay. You need to manage, you need to understand the cycle and move with it. So there is the market are not, nothing is bad in the market. We are continuously growing, and of course the same stocks might not be doing well down the road, because each sector has a cycle. Some stocks will outperform for one trend, some stocks will underperform an entire trend, which could run into years. For example, pharma was a underperformer from 2015 to 2020, major underperformer. Or say Tata Motor and Tata Steel, 4 5 years of underperformance, and look at where Tata Steel is today. In another, or even if you look at Tata Power, 2008 to 2020, 12 years of sideways. If anybody invested money in Tata Power in 2008 subprime low till COVID low, did not make any money. That's 12 years you're paying interest from your pocket. But look at the move from the 2020 low till today. That's a phenomenal thing. Na? So it's a cycle. So similarly, markets are not going anywhere. Markets are going to see up, downs, and all that. But good stocks will have the cycle, will outperform. They'll continue to do well. Like that.
Great. That's amazing. Really feel good about this, Dinesh. And I think you really encouraged all of us to be in the market, and the way you explained us about risk management. Of course, the studies are important, but what I liked about one question which you said, like if someone is saying, I'm going to buy this stock, you said, yeah, buy it. What is your target? Before that, you ask what is going to be your stop loss. So that is very important. That's risk
Absolutely.
management. Yes, that was very enlightening.
So yeah, because two reasons for that. Two reasons for that. Number one,
Yes.
maybe that person is genuinely suggesting a stock after a very good study. Okay. But that person can also go wrong. Okay.
Oh, yes.
Forget the part that the person is just doing a WhatsApp. Forget the could be a WhatsApp forward from one person to the other person, a copy paste. Okay, forget that aspect. I'm saying a genuine person with a high track record, with a fantastic study of the market is recommending something to you. But that person can also go wrong. Okay, so always know your risk before you enter
Yes.
something. Always, always know your risk. Okay.
So, friends, whatever we shared today is only and only for your knowledge purpose, and these are not recommendations. So, please do your own studies and invest. For further knowledge, you can always DM us. So you can DM Dinesh, Peter. You can follow Paytm. Of course, you're doing following Paytm or me, or Peter or Manas. You're already doing that. So wish you all the very best and have a great financial new year ahead. And thank you, Dinesh, for giving enlightening us with your 2 decades of experience, over 2 decades. Thank you, Dinesh. Thank you, everyone,
Thank
for
you,
Thank
Dinesh,
you
for a
attending.
for having
wonderful
me
time
over.
today.
Thank you for having me over. It's an honor.
We
It's
really
an
enjoyed
honor.
it.
It's an honor to be here.
Thank you,
Thank you.
Thank
Dinesh.
you.
Thank you, everyone.
Thank you,
Yeah.
listeners. Thank
We'll
you for
meet.
being.
Yeah.
Thank you,
We'll
Paytm.
Thanks
meet next
everyone.
week.
Bye.
6
Have
p.m.
a great
Take,
Yeah.
weekend. Thank you.
take care. Thanks.